Okay, well, let's take a health check on the UK economy. Joining me is Azad Zangana. He is European economist at Schroder Investment Management. Thank you very much for joining us. If we could look first at what we heard from the Bank of England minutes today. They do seem determined to keep interest rates where they are at the moment. I suppose the problem is that if inflation is at 4.5% and we're still not moving interest rates for fear that it might weaken consumer confidence, what needs to happen for there to be enough of a sea change that interest rates can rise?
Well, I think at the moment what we really need to see is a sharp pickup in wage inflation or a sharp fall in unemployment. And as highlighted by today's numbers from the labour market statistics, we're not seeing that yet. We did see a small pickup in bonus payments, especially to the city, but certainly not enough to concern the Bank of England at this point in time. Now, what was very concerning for markets, and you're absolutely right, inflation now running at 4.5%. But of course, at the last inflation report, there was a real warning from the Bank of England that inflation could rise to 5% by the end of the year. And yet the language in today's minutes from the MPC meeting still very much very cautious, signalling that interest rates could remain low for some time.
And the thing is that if there is this lack of consumer confidence, at 4.5%, inflation is beginning to really bite and it's hitting people's pockets. Inflation would only add, an interest rate increase would only add to that, wouldn't it? Because it would affect people's mortgages as well.
Oh, absolutely. It would reduce disposable income for households, and it could hurt consumption. But what has been interesting is that consumption has held up very well, even despite the sharp fall in consumer confidence. And we think that the reaction of consumers has really been driven by fears of job losses, particularly in the public sector, which we think have really been overdone. So at some stage later this year, we think that consumer confidence will rebound and consumption will also pick up.
And at that point, is it going to be possible to have an interest rate rise? I mean, I'm interested to know when you think that might happen.
Well, we think it could happen in the third quarter, August, or possibly even September. But that is very much based upon a recovery coming through in consumer confidence, but also some stronger GDP numbers would be helpful. Of course, we haven't actually had any GDP growth over the last 6 months or so. A lot of that it has been snow-related, but once you net that all out, very much a flat economy, stagflating even, you may say, given how high inflation has been.
Indeed, indeed. Well, the EU and the IMF are waiting for Greece to give further details of its plans before paying the next tranche of cash. Well, still with me is my guest, European economist at Schroder Investment Management, Azad Zangana. Thank you very much for listening to all of that for us. I'm interested to know what your reaction is. Which side of the fence are you on? There seem to be those that think that restructuring is necessary and those that think it's going to have a lot more impact.
I think restructuring is necessary, but not in the short term. I think the biggest risk of any kind of restructuring in the short term would be a loss in support from the European taxpayer for the bailout mechanisms that we have before us. And that really could jeopardize the aid that is being provided to Ireland, Portugal, and potentially Spain if it comes down to it at some point in time in the future.
So when you say not in the short term, are you thinking of kind of post-2013?
Absolutely. Once the European stability mechanism has been set up and European leaders have the ability to restructure private holdings of debt and not that's being held by the European taxpayer, then I think we can restructure the debt without affecting sentiment towards the European project.
Now, you mentioned Spain there. There are many who would like to hope that Spain has managed to decouple itself from those other three nations that have already sought a bailout. Do you think that that's happened yet?
I think it's far too soon to say it's happened. We've seen Spanish yields today rising a little bit over bonds. I certainly don't think they're out of the woods. And really what we need to see is not only with Greece, as mentioned in that report, but also Spain picking up efforts to reduce their fiscal deficits as quickly as possible.
There does seem to be a will to address some of the fundamental problems within the EU. Does that need to be done as a matter of priority in order to make sure that this chain reaction doesn't just continue and get worse?
I do, and I think a lot of this debate is taking place at the time when Greece is behind the scenes trying to negotiate an extension to its bailout or further money being pumped in. But of course, this isn't going to be a free lunch. The IMF and European Union partners rightly are requesting more progress being done on the privatization program in Greece, but also on other structural reforms that also need to take place. Because at the end of the day, one of the big disappointments with the Greek package so far has been the very weak rise in tax revenues. And that hasn't happened by accident. It's happened because of a lack of growth and a lack of structural reforms.